Bitcoin is probably less volatile than similar-sized assets like Apple stock or even Tesla stock.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in.
We're not out of the woods yet, but I'm glad to say that we are now making real progress.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the early edition on this Tuesday, May the 4th. I'm Francine Lacqua in London, and here's what's coming up on today's program. Progress, but not for all. Jay Powell paints a patchy picture of the U.S. recovery, while the Fed's John Williams says the recent positive data are not sufficient for a change in course. Europe's reopening. Germany pushes ahead with plans to exempt the fully vaccinated from restrictions. Denmark says it won't use Johnson & Johnson's vaccine. And Bill and Melinda Gates announced that they're getting a divorce. The couple, who jointly control a fortune of $146 billion, say they will continue to work together at their foundation. Well, good morning, everyone. May the 4th be with you. The U.S., it's a joke here in the U.K. especially. The U.S. economy is making real progress, according to Jay Powell, but not for everyone. The Fed chair said that gains have been uneven following a downturn that cut hard lines of race and income. While speaking at a community college in Virginia, President Biden insisted that no recovery would be complete if some Americans were left behind, calling on big business to pay its fair share.
I'm not anti-corporate, but it's about time they start paying their fair share. It's about making a choice. You know, we have out there this year, you have 50 corporations making $40 billion that didn't pay a single penny in taxes, not a single penny. I don't want to punish anybody, but everybody should chip in. Everybody should pay something along the road here.
Well, these comments come as confirmed coronavirus cases in the U.S. rose at the slowest pace since the start of the pandemic. Now, in New York, most capacity restrictions will be lifted with a resumption to all-day subway service. Now, let's get straight to the markets with our Danny Berger. Danny, what's the story today? I know they're very focused also on chip shortages.
Yeah, and look, I think we're at this point where the recovery genie is not going back into the bottle. Yes, we had those Powell comments about a patchy recovery, but at the same time, it is clear that these manufacturing bottlenecks are impacting the economy. We had the ISM manufacturing report in the U.S. yesterday, and I think it was really telling, not just the fact that it did weaken, but some of these comments from companies talking about inflation of prices across most, if not all, supply lines. I'm worried about getting the materials to support the company, and steel prices are crazy high. So these are the things we're hearing, not just in the survey, of course, but in earnings as well. And the reaction in markets, the ISM manufacturing report also talking about manufacturing prices at their highest since 2008, was very swift. It is a little bit different than what we saw today. So oil did move higher after that report. It's higher again today. Yesterday, it was a story of dollar weakness. Today, it's coming back with strength. And that is really one of the key parts to where the markets are trading today. At the same time, equities taking a bit of a beating. Again, what does this mean for companies? Does it mean worse inflation? Does it mean passing these prices on to consumers? But we have both futures and NASDAQ futures weaker today. That big tech sector, of course, underperforming both yesterday and today. And then this is the persistent story. This is the Bloomberg Commodity Index. You can see what it's done over the past 30 days. But at the moment, trading at its high since 2012. So that means in the European session, it's those miners, it's those material companies that are outperforming today. But as Sebastian Gailey from Nordea put it, COVID-19 has been a ripple in the pond, and all these different ripples are meeting up in terms of inflationary causes. The one today that we're focusing on, Francine, is this. It's commodities.
It certainly is. Danny, thanks so much. Danny Berger there with the very latest on commodities. And of course, a little bit later, also, we'll look at the implications and the ripples that the divorce of the Gates is having through business and philanthropy. Now, joining us to talk about the markets is Jeff Yu. He's BNY Mellon Senior Strategist for EMEA Markets. Jeff, always great to speak to you. So thanks so much for coming on. When you look at the commodities and the chip shortage, what will actually drive the markets in the couple of weeks and months? Is it still the specter of inflation coming quicker than expected, or can it be something else?
I think it'll be two things for the two biggest economies, US and China. US, absolutely, it is inflation. It's just going to be healthy inflation. or is this going to be, if it's only supply side driven, is it going to be stagflationary as well? So you're going to get margins under pressure due to higher input costs, but not much love elsewhere in terms of demand. So I think that is something that the Fed will have to manage. And on China, it's interesting, more and more investors, they're worried about over-tightening. They're worried that there's been too much hit to the housing market in terms of regulation. Will China actually disappoint to the downside in the second half of the year? So that's going to be disinflationary. So I think these two price factors leaning against each other is going to be really interesting over the next quarters also.
So, Jeff, what does it mean in terms of where you want to go big? Is there a certain position or a portfolio that actually you like at the moment, given what you've just explained?
Well, actually, I think Europe is sort of in the sweet spot, in particular for the Eurozone, because the bar's always been high for markets to believe in European reflation. And now I think that is taking place right now. We have the reopening. We have the unlocking, announcing plan for tourism to return to Europe, for example. But crucially, the German elections, the Greens are still in front. Is that going to not only lead to greater investment within Germany, but also closer fiscal integration within Europe? That's going to be reflationary as well. And finally, if that's where the value is, if that's where your discount is, I think the flow will start to fill for Europe as well. UK to a lesser extent, but I think that's where we are going to see a sweet spot. And Euro right now, valuations are still fairly favorable.
Jeff, overall, what will it take for some of these equities to correct? Are we there yet?
I don't think we're there yet, given markets tried to shake out the Fed in March and didn't really work. So judging by Chairman Powell's comments, and also we heard from Williams as well, there is no rush to move forward. Sometimes I think many Fed members are frustrated at the pace at which markets want to push this tightening agenda. So loose financial conditions, at least you do get some wiggle room for equities. But if we have a combination of stagflation in the developed world and lower than expected growth in China, that double whammy is going to be very, very hard for equities to ignore.
When you look at dollar dynamics, I guess, we're still, again, trying to figure out what the U.S.-China relationship looks like, and actually if Europe will have to square off with the vision of Biden's administration on how to deal with China. Could we see further trade disruption like it was under Trump?
So relative to the last U.S. administration, I guess the answer is probably not. But that is a very, very low bar. Simply hoping things don't get worse. Hopefully we can actually strive for something better. But alas, and given the way relations are going right now between China and the rest of the world, probably things won't get any better right now. So I think that's more of an opportunity cost. It's a missed opportunity whereby if all the global economies can actually work together to speed up, to hasten the pace of recovery, that could be much more beneficial for risk. But alas, it's not going to happen for the time being. But on the other hand, things aren't going to get worse. And I think we can just take that as an insurance policy.
Jeff, what does it mean for dollar then? Does it go up or down from here?
So dollar, I think we are neutral for the very, very short term, but structurally we still think valuations-wise, the dollar needs to correct lower, right? So the asset allocation trade, assuming China doesn't have a softer than expected growth that I talked about just now, I think this asset allocation shift towards Asia, that will continue because that's going to be where the growth is, and that's where valuation is still favorable. Europe will benefit as well. Fed will keep real yields relatively low in the US, and as a result, I think the dollar will continue to weaken from here over the medium to longer term.
Jeff, thanks so much. Jeff Yu there of BNY Mellon stays with us now. Coming up, Bill and Melinda Gates announced their plans to separate, splitting a fortune of $146 billion. But what happens to one of the world's largest private philanthropic organizations? Well, we'll talk about that shortly. And also up next, pressure rises on Indian Prime Minister Narendra Modi to shut down the country as virus deaths rise. But in Europe, Germany also pushes ahead with plans to reopen. We discuss the uneven global recovery next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Let's start in Mexico City, where a raised subway track has collapsed, plunging train cars with passengers on board to the ground. At least 20 people were killed and 70 others injured. Mexico City's mayor says the accident was caused by a broken beam. The subway line that collapsed opened back in 2012. The project suffered from design problems during construction. Now, in India, Prime Minister Narendra Modi is resisting pressure to lock down the country despite the surge in virus cases and deaths. 2 weeks ago, he said states should only consider lockdowns as a last option. But now everyone from political allies to business leaders see it as the only way to stem the world's worst coronavirus outbreak. The White House is backing Pfizer's move to begin exporting US-made doses of its coronavirus vaccine. The governments of both Mexico and Canada said last week that they expect to begin receiving the vaccine from the US. The New York Times is reporting US regulators could authorize the Pfizer-BioNTech vaccine for 12 to 15-year-olds, and that's as soon as this week. And Bill and Melinda Gates are getting divorced after 27 years of marriage. The two say they will continue to work together on the Gates Foundation they both created, which has so far given away more than $50 billion. According to Bloomberg's Billionaires Index, the pair are worth an estimated $146 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Germany is looking to loosen some of its COVID restrictions for vaccinated people. Proposed new laws could mean those who have been inoculated will no longer be subject to curfews or restrictions on socializing. Now, this comes as the EU looks to open its borders after more than a year of relative isolation. Jeff Yu of BNY Mellon is still with us. Jeff, first of all, is there a danger that we're too complacent on actually what vaccinations do, and will that lead to even two-speed recovery in Europe?
I think the two-speed recovery in Europe is something that the ECB and other policymakers are very concerned about already. So that's why the European Commission is pushing for a consistency. But if you look at the scenario analyses of the ECB, of any central bank out there, there is a fear of a new variant coming through, that vaccination does not do the entire job. So I think that's why, in terms of normalization, with very, very few exceptions, such as Norway and Canada, all central banks, they want to keep their options open. They want to see the pandemic situation almost fully under control, confirmed by science, before moving aggressively forward. So that's something that's almost always at the forefront of policymakers' expectations.
And Jeff, of course, we look at those horrific pictures from India, and our hearts really go out to the nation and a lot of the neighboring nations that could also be dealing with, some considerable variants. What does it mean for, some of investors' appetite for emerging markets when you look at how the situation has evolved, how it's been handled, and actually the delay in the vaccinations arriving?
Right. If we look at client interest and also our custodial flow data, called iFlow, it's actually fascinating because we talked about Europe doing well during the third wave, for example, as a catch-up trade. We are seeing some senses of that with India, with emerging markets as well. I mean, clearly, the current images are devastating. But at the same time, the view is, with global coordinated effort, I mean, look at how much help is being given to India right now. Of course, more can be done. But hopefully, and we've had comments along these lines already, the situation can stabilize and actually improve. So on a forward-looking basis, and perhaps some people are looking for value in investing in India and some other relevant economies at this point. So I think there's kind of support coming from markets, making sure there's not a great gap out in terms of financial conditions. That happens if there's a big sell-off in your markets. That is actually helpful towards the future economic recovery as well. So it's quite heartening to see, people are not doing knee-jerk reacting to what is clearly a very difficult situation.
But Jeff, how difficult, again, we're not virologists, and even the virologists have a tough time finding out exactly what variants will come from where and how we deal with it. So are we going to be in a situation where, 12, 18 months from now, we could have, even if it's not as bad a situation, a pretty bad situation when it comes to COVID? Or do you think that actually now we're in a recovery phase and it'll be smooth sailing ahead?
Right. So if I can borrow the phrase, a variant discount, right? So the risk of COVID coming back in some shape or form and hitting the world economy along the lines of what we saw in March last year and earlier this year, that clearly is embedded in asset pricing. Yes, we're not seeing that much volatility and valuations are rich across different markets, but you can't prove the counterfactual. If we didn't have COVID right now, if we didn't have to worry about scarring, if we didn't have to worry about some holding back investment intentions, where would equities be? Where would global growth be? So again, that is at the forefront of policymakers' expectations again, but it's a lot of guesswork. You don't know what's going to happen in 2 years' time, 3 years' time. So again, for a company, they want to make a 5-year investment plan. You can't do that right now. So it's the foregone cost of growth that really is embedded into asset prices right now, and it's something we have to take into account.
Jeff, where do you see gold going? Is there something that you want to be invested in right now, or does it just look like you can find value elsewhere?
Right. So gold is almost a pure play still on US real yields. I've always held that view. So if US real yields are not going up, so US dollar real yields are not going up aggressively, gold, I wouldn't say find a strong bid, but perhaps downside is limited. But given at some point in the future, not immediately, but if the only direction for US real yields is higher, be that 6 months or a year down the line, then I think that's where gold will be capped. I'm more concerned right now about just the global supply shocks that you mentioned earlier. If I look at iron ore, if I look at hog prices, I look at soy, everything is going up right now. And is that just purely supply? Is that something else? It's something that, when it comes to inflation and corporate margins, we all have to deal with, in particular central banks. It makes policymaking a lot tougher.
Jeff, what about chip shortages? I mean, this is one of the things that, certainly hurt the markets yesterday. I look at some of the comments from Intel saying that this could last a couple of years. Where, what are have we fully understood the ramifications of this, or could it actually get worse?
I think down to the consumer, when you have people just simply buying cars being told, sorry, you have to wait another 6 months or 12 months because I can't put the chip into your sat nav, I think that's going to start to filter through and we will start to feel it. But let's turn this into an opportunity. So we know Taiwan's situation where the manufacturing chips is very concentrated. So global supply chains are actually sort of stretched right now because of the dearth of them sources for that. If this is going to be turned into an investment opportunity amongst many different economies to push for better supply chains, I think this could actually help lift growth as well. But in the short term, like the same situation with soy and iron ore, it is going to be inflationary. But again, if it's only supply side inflationary, that's not necessarily something central banks will react to via rates.
Thank you so much for joining us. Jeff Yu there, BNY Mellon Senior Strategist for EMEA Markets. Now, coming up, Bill and Melinda Gates announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We'll have plenty more on that shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, after 27 years of marriage, Bill and Melinda Gates are going to separate their separate ways, according to an announcement made on Twitter by Bill Gates. The couple jointly control a fortune of around $146 billion, but made no hint of their financial plans. Well, joining us now is Danny Berger. Danny, I mean, there are quite a lot of questions because it will send ripples through the business and, of course, philanthropic community. They've been one of the most influential foundations in the world. What do we know about the fate of it?
Well, irretrievably broken is how the couple described their marriage in a filing obtained by TMZ. And really, despite that strong and frankly quite sad statement, the message they've put out when it comes to the foundation is one of continuity, both in terms of that statement Bill Gates put out on his Twitter and from the spokesperson. And you have to imagine that both Bill and Melinda Gates, they're known as pragmatists, and any fracturing of the foundation would dampen its impact, would dampen the say it has in terms of the good works it does. So that at least for the time being, is really the point that it seems they're trying to drive home in all of this.
So what about their finances and Microsoft stock? What do we know what happens to that?
So we don't, and it very well could be that we never find out what happens. In Washington state, they are able to file contracts privately and keep this out of the public eye. But look, when it comes to the impact to Microsoft, there's likely not to be one. It's not like Amazon and the Bezos' divorce, where most of their net wealth was wrapped up in Microsoft. Bill Gates only owns a little bit more than 1%. Instead, most of their net wealth is in Cascade Investment, a family office. And if you look at the things that they own, it's going to be things like real estate, energy, some public stocks. But these are things that are difficult to divide. So it's going to be a little bit more of a messy allocation of finances. At the same time, Washington state, the way that divorces work there, any assets accrued as a couple during the marriage are seen to be equally divided. So there are a lot of different factors that could, again, complicate what the outcome of this divorce is, Francine.
Danny, I mean, it is actually quite incredible to think of, I guess, a more renowned couple getting divorced and having impact so wide and far. Have we had many reactions from people?
I mean, I think that a lot of times this is really being compared to just, a year ago with Jeff Bezos as well. So I think it is surprising, more or less.
Dan, thanks so much. Our Danny Berger there with the very latest on the story. Now, coming up, G7 foreign ministers meet in person in London this week. The meeting comes as European nations get closer to the U.S. position on China. We'll look ahead on the key topics on the international agenda. That's coming up shortly, and this is Bloomberg. Progress, but not for all. Jay Powell paints a patchy picture of the U.S. recovery, while the Fed's John Williams says the recent positive data are not sufficient for a change in course. Europe shifts back to America. We'll have a full roundup of the G7 meeting in Europe with our Rosalind Matheson. And Bill and Melinda Gates announced that they're getting a divorce. A couple who jointly control a fortune of $146 billion say they will continue to work together at the foundation. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition. Now, on this Star Wars Day, May the 4th be with you. Foreign ministers from the world's leading economies meet in London for their first face-to-face talks in more than 2 years. Now, the G7 are expected to discuss new ways for the group to defend international rules from external threats. The UK Foreign Secretary Dominic Raab will lead the discussions in a joint press conference with the US Secretary of State, Anthony Blinken. He said that Britain and the United States are on the same page when it comes to dealing with China.
We also discussed China. I think it's fair to say we see eye to eye on the need to stand up for our values, holding Beijing to the commitments that they've made, whether it's in relation to Hong Kong under the joint declaration or wider commitments.
Well, Rob's comments signal a shift in attitude towards China this side of the Atlantic. The EU, which signed an investment agreement with Beijing back in December, also seems to be moving closer to the views of the Biden administration around China. Well, joining us now to discuss all of this is Bloomberg's executive editor for international government. She is Rosalind Matheson. Ros, great to have you on an important day like today. What seems to have prompted this shift by Europe?
Well, as you said, it is a quick shift because only back in late December, they'd finally agreed on that big investment treaty between the EU and China, and that took 7 years to get there. And so that felt like things were on a different kind of trajectory, but only in the space of 4 months, our sources in some of the key capitals are telling us there's been a significant turnaround, a hardening of views about China, and much more of an alignment with the Biden administration on how to tackle China's growing economic and strategic clout. And there's a combination of factors behind that. One seems to be China's behaviour in terms of its political crackdown on Hong Kong, of course, its treatment of the Uyghur Muslim population in its own province of Xinjiang in the west, and sort of tensions with Taiwan, and a broader sense that even as this treaty was being negotiated, that China is still not showing genuine progress in opening its own economy to the world and including to European companies, and it's protecting its state-owned enterprises. So even as that treaty was being done, China's not showing the kind of goodwill that Europe is still looking for, and particularly now questions around control of things like technology and how to regulate tech companies. And that's all feeding into this feeling just in recent months that things have taken quite a turn when it comes to the perception in some of these key capitals in Europe.
Well, how will they deal with Russia, Roz? I imagine it will come up.
Well, yes, this is actually the first time, of course, that the foreign ministers are meeting in person, face-to-face, in more than 2 years. And what that enables is a bunch of sideline conversations around the meeting, aside from just seeing each other on a Zoom call. And so you can expect that Russia's definitely going to come up in multiple ways. Of course, there is that potential of a summit next month between Vladimir Putin and Joe Biden in Europe. But equally, there's a lot of concern around Russia's recent actions on Ukraine, its treatment of the opposition leader, Alexei Navalny, and, of course, the US would really like Germany to take a much harder line on Russia when it comes to the Nord Stream gas pipeline from Russia into Germany. So what we can expect, of course, is a sideline chat between the US and Germany around that. Overall, there is that overarching concern as well just about Russia's behaviour, and the UK, of course, as the host, will be first in line to sort of air those concerns at the meeting starting today.
Roz, what are the other likely issues on the table?
Well, there's quite a lot on the table aside from the pandemic and trade. Of course, there's also issues around Iran and North Korea, because we've been having these conversations for several weeks now to try and get the Iranian nuclear deal back to life, of course, after the US under Donald Trump was withdrawn from it. It's complicated by the fact the US and Iran won't talk directly, but these nations that are meeting here today are essentially passing notes to either side between them, trying to work out a way to have a coordinated move that would allow that deal to be re-energized, because neither side wants to blink first. So there'll be a lot of discussion around that behind the scenes. And the other thing is North Korea, because the US is starting to formulate its policy on North Korea under the Biden administration. It's probably going to be a combination of diplomacy and some harder lines. So it will be sounding out other countries here this week on that, including South Korea and Japan, which are, of course, attending the meetings.
Roz, thank you so much. Bloomberg's executive editor for international government there, Roz Matheson. And of course, we'll hear from Roz throughout the day. Now, Fidelity slashes Ant Group's valuation estimate. The Boston-based money manager has lowered the implied valuation for Jack Ma's company by half. Now, the move follows a Chinese regulatory crackdown on the fintech giant. Well, joining us with more of the details is Bloomberg's Ant Group reporter Lulu Chen. Lulu, what, first of all, are the details for Fidelity's estimate?
Well, Fidelity has lowered the implied valuation for Ant to about $144 billion at the end of February. That compares with a $295 billion value assigned to the company in August, meaning that the company essentially halved its valuation for the fintech giant. It is quite a drastic cut, but it's not the worst, given how some analysts are estimating much more severe slashes in valuation.
So, Lulu, how are the funds and investors actually looking at Ant valuation now?
The range is quite varied and quite wide. Our sources tell us that most funds that have invested in Ant are placing a valuation of $200 billion to $220 billion for the company. We've also reported that Warburg Pincus, which is one of the more famous global funds, and the company placed its valuation at 200 to 250. Those are all marked down compared with what the company was valued at in the run-up to the IPO. That said, it's still not as drastic as what Bloomberg Intelligence analysts are saying. They estimate that in the worst-case scenario, the company's valuation could fall to as low as $29 billion.
Lulu, when you look at some of the overhauls that Ant could face, how different will Ant actually look like in 24 or 38 months from now?
So there's still a lot of work that the company needs to do. Regulators have asked it to overhaul the company and change itself into a financial holding firm that tit-tat has been given to most of the fintech companies in China. And so the industry sector-wide is going through this overhaul. One of the more concerning trends that is emerging is the regulators asking that Ant sever the improper linkings between Alipay and its other financial services. Now, Alipay has 1 billion users, and one of the selling points for the company has been that it could create a lot of synergy by directing all that traffic from these users into the other financial services. And that synergy is what really underpinned the lofty valuations that we saw and why analysts were willing to assign much higher premiums to the company compared with traditional financial institutions. So the future of Ant is still uncertain. That said, the company has promised that it will go public eventually.
Thank you so much, Lu Chen there, Bloomberg's Ant Group reporter. Now, coming up, a new study from HSBC reveals that only a third of investors surveyed are bullish on emerging markets over the next 3 months. We'll find out why from one of the authors of the report. That's coming up next, and this is Bloomberg.
You can say it was a lack of foresight, a lack of leadership. One is certainly anybody paying attention to what was happening in the rest of the world, in Brazil, for example, should have recognized the virus does come back and potentially in more virulent forms.
Well, that was Raghuram Rajan, the former Reserve Bank of India governor, sharing his insights on India's coronavirus outbreak as it continues to worsen. The Prime Minister Narendra Modi continues to resist calls from top business figures and world leaders to lock down the country. This is a move as his government has so far avoided after the economic devastation last year. Now, India is suffering the world's worst outbreak of COVID-19 cases, with deaths hitting a record on Sunday, and new cases above 350,000 a day. It's not just India that's been impacted by new virus waves. Other developing nations such as Lagos, Nepal, and Thailand risk facing a similar crisis. Well, HSBC's fourth emerging market sentiment survey reveals that only a third of investors surveyed are now bullish on emerging market prospects over the next 3 months. Let's get more on this with Murat Ulgen, HSBC Global Head of EM Research, who joins us now. Murat, first of all, thank you so much for joining us. Now, apart from the human tragedy, which of course we think about on a daily, if not hourly basis of what's happening in a lot of these emerging market economies, what does it mean for investors? Are investors worried about getting in, given they don't know how these variants and COVID develop?
Well, thank you very much for having me. I mean, as you said, the bullishness has dropped significantly to nearly a third in our latest survey, whereas it was like 3/4 of investors bullish on EM prospects in the near term when we did the survey previously in January. But it's not like they're bearish. They're just neutral. I mean, nearly half of the investors have adopted a neutral stance on emerging markets. They sit on a lot of cash. They drop their risk appetite. And it all tells us that they lack strong conviction. They lack a medium-term view, perhaps also part of the global environment. I mean, COVID is an issue, as you mentioned, but the biggest risk perception for EM at the current juncture is actually higher inflation, both globally in the US and higher rates, but also across EM. And that seems like is holding investors back at this stage.
But Murat, so what would be a good catalyst actually for investors to get into emerging markets?
It's a very good question because there's lots of cash. I mean, we've seen also huge inflows, nearly $90 billion going into EM equity and fixed income funds, based on the data we track on a weekly basis. A little bit less than $70 billion into equities and 20 billion plus into fixed income, more so into equities. They actually use that cash in primary markets, in IPOs, in issuances, corporate, sovereign, quasi-sovereign. But the secondary market performance has been weak. And to your question, what could be the catalyst to put that cash to work? they are probably looking for, better data. I mean, we're now entering, obviously, an episode where there will be huge macro data volatility because of last year's base effect. And inflation is a major worry. 77% of investors now cite they expect higher inflation across EM, and nearly half actually are worried about higher inflation and higher rates in the US as a major impediment. I would say it's probably data as it comes in. Perhaps we'll see this sort of big, spike in inflation in the US and elsewhere in the second quarter. And as it subsides, as we expect actually as a house in the second half of the year, maybe they'll be more convinced to put cash to work.
So where do you think the money flows first? Is it, again, there's politically a bit more stability in some of the Asian emerging markets and maybe some of the South Americans. How do you make that difference, and what are investors telling you?
Yeah. So in this survey, it seems like investors once again prefer Asia's stability, which was the case in the previous surveys last year. But in January, when they become very bullish, they were branching out of Asia. But now they're back to Asia. Asia still remains the most overweight across all asset classes, by the way, which is, equity, fixed income, FX, etc. We've seen some overweights that have gone up in Middle East. But the overweights have been reduced in Latin America. So it seems like the preference is Asia. The preference is still equities over fixed income in the near term. So, one might expect as cash is put to work, as investors get more comfortable with data, maybe these regions will benefit first, and then the other ones will follow afterwards.
Murat, when you look at what the Fed does and the inflation, some of the inflation, I guess, concerns that sometimes makes equities and certain parts of the markets, if not panic, certainly take caution and urge. Where do you expect dollar to be, and how does that impact the emerging markets that you're looking at?
Thank you. Our house view is still, some modest depreciation of the US dollar. Our FX strategists are looking for euro dollar 123 at the end of the year. So a little bit more weakness from here as we expect, global economy to regain, sort of its poise, as the global economy recovers more in a synchronized fashion, maybe in the second half of the year, as vaccines are rolled out in the rest of the world across emerging markets. Europe gains traction. We do expect, this would probably weigh a little bit on the dollar, but not too much, nothing aggressive. I think for emerging markets, you might argue the backdrop, as we project, perhaps like more range-bound US dollar. And if that's the case, I think, with this huge amount of cash and as investors really become comfortable with the inflation outlook as we expect, perhaps we can see EM performance gaining some traction.
And do you play it through equities or actually fixed income?
At the moment, it's equities. Since the beginning of the year, our core recommendation was actually EM equities over EM fixed income. There are many reasons for that. For one thing, we think the global macro backdrop is still more equity friendly. The second thing, the earnings yield across equities are still much higher than EM fixed income yields, either local or external, and the Sharpe ratios are not too different. EM equities trade at a deep discount compared to DM equities. It seems like the earnings cycle perhaps is topping out a bit in Asia. The other parts of the equity universe is looking interesting now, EMEA and Latin America. And within the equity domain, specifically commodities, especially the commodity-related stories we think are quite interesting. You might see some upward earnings revisions. And also the currencies. We've been communicating this since the beginning of the year. The commodity currencies across EM space haven't reflected the gains, the huge gains in commodity prices, in terms of trade gains, which will eventually have to filter into, trade numbers and current account numbers. So yes, equities over fixed income, but specifically the commodity space.
Thank you so much, Murat Ulgen, their HSBC Global Head of Emerging Market Research. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Apple's battle with the maker of Fortnite has begun in federal court. Epic Games is alleging that Apple's App Store leaves users and developers trapped in an anti-competitive marketplace. But the iPhone maker is hitting back, accusing Epic of a fundamental assault on a business model that has helped millions of developers. Now, Robinhood is hitting back at Warren Buffett after he said the online brokerage played a part in the casino aspect aspect of the market. In a tweet, the retail trader favorite said the old guard preferred it when investing just wasn't so easy, adding that Robinhood isn't going to sit back while its users are disparaged from taking control of their financial lives. And profits at the oil giant Saudi Aramco soared in the first quarter. The recovery in global oil and gas markets helped the state-owned firm maintain its dividend. It kept the quarterly payout at nearly $19 billion. Almost all of it goes to the Saudi Arabian government. The bumper results follow strong earnings from other big oil names like Shell and BP. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, coming up, Bill and Melinda Gates announced their divorce on Twitter, but made no hint of what happens to their joint fortune of $146 billion. We'll try and have the details next. This is Bloomberg.
Europe is on a good track, and the one thing that has held back travel in the last 12 months is the uncertainty about transportation. Can you actually get to your destination, and can you get back without any quarantine restrictions that are imposed on a short notice? So a clear structure in place will be very, very positive for the summer season.
Well, that was Trivago's Axel Heffer speaking to Bloomberg. The chief executive of the travel booking website says a rebound in the travel sector is being held back by uncertainty around coronavirus restrictions. I certainly know a few people that are waiting to book their flights if they're allowed to travel. We'll hopefully hear that very soon. Now, Bill and Melinda Gates have announced that they're divorcing. The pair, who have overseen one of history's greatest fortunes and philanthropic organizations for decades, made the announcement last night on Twitter. They said that they will continue to work together at the foundation, but will no longer believe we can grow together as a couple in the next phases of our lives. Now, as co-founder of Microsoft, Bill Gates accrued a wealth of $146 billion controlled jointly with his wife. Well, let's discuss the implications of the separation on Microsoft and the foundation now with our wealth reporter, Ben Stupples. Ben, great to have you on the program today. They have really one of the most influential foundations in the world and with a lot of money to give away. What do we know about the fate of that foundation?
Hi there, Francine. Yes, well, right now, all we know, based on the news that only obviously broke very recently, we know that they're obviously going to continue to be involved together through the foundation that they set up together. Now, the question remains, of course, over how this 146 billion fortune is going to be divided. And I think it's worth pointing out that Bill Gates previously tried to separate his own personal fortune from issues related to fossil fuel, and that took several years. So it's sort of the question raises for me now is how long is this going to take? Because this is a very complicated fortune that has assets spanning several industries. It's very different to the divorce that we saw a few years ago with the Bezos family, which was very much related to the singular holding in Amazon.
So, Ben, what about their finance and Microsoft stock?
So actually, it's quite an interesting question there, Francine, because actually Bill Gates left the Microsoft board last year. So we actually don't know right now how specifically how much Bill Gates has in Microsoft. And actually, Bill Gates' fortune in Microsoft is only about 20% now. His stake in Microsoft, the latest that we know, he makes up only about 20% of his overall fortune. So what he's done over the years, very different to, say, Mr. Jeff Bezos. What Bill Gates has done over the years is plow the proceeds of Microsoft into his family office, his personal investment firm called Cascade, along with the Bill and Melinda Gates Foundation that they've given about $50 billion worth over the past decade at least. So actually, the Microsoft stake is far smaller here. Actually, it's the family office and the foundation that make up the bulk of their fortune right now.
Ben, thank you so much. Our wealth reporter there, Ben Stupples, of course, will continue watching Bill and Melinda Gates, and maybe we'll have a little bit more news about what happens to the foundation, what happens to some of the stock options in the couple of hours to come. Now, this is what I'm looking at in European stocks. They're definitely drifting. A lot of important news on tech and also on chip shortage. This is what drove markets lower yesterday. Still continuing to watch, of course, the chip shortage, with Ford in Europe saying that actually this may last a little bit longer than expected. It's a similar situation of what we heard from the Intel chief executive. Bloomberg Surveillance Early Edition continues in the next hour. Kailey Leinz, Matt Miller join me out of New York and Berlin. This is Bloomberg.
India is in clear need of international assistance, as will other countries be quite soon, if not, now.
What we're seeing in India is, the health system just simply cannot cope with the numbers.
Anybody paying attention to what was happening in the rest of the world, in Brazil, for example, should have recognized the virus does come back and potentially in more virulent forms.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London, Berlin, and New York on this Tuesday, May the 4th. And good morning especially to all those Star Wars fans out there. Our top stories today. What a drag tech shares are holding back markets in Europe and the U.S., among them big names like Amazon and Infineon. Choosing sides, ties between the EU and China are quickly getting worse. Europe is moving toward President Biden's position when it comes to Beijing. And billionaire breakup, one of the world's biggest fortunes, is at stake as Bill and Melinda Gates plan to divorce. Now, a lot of the focus on the markets is also what we heard from the Fed chair and also John Williams. Kailey, I know that's playing out in the markets. And of course, we look at technology with chip shortages. What else are you seeing?
Yeah, there's definitely a lot of factors at play here, Francine. I would note that in the Asian session, we did still have some markets closed for holidays, including Japan and China. But others were open and trading, and it was a bit of a mixed picture. The Hang Seng was higher by about 0.7%, but Taiwan stocks under pressure. And I would note the Sensex in India actually has flipped into negative territory now after gaining earlier. We, of course, still have the ongoing crisis in that country. And as a result, the Indian rupee is also giving back some of its gains against the dollar, though it is still fractionally stronger. The Japanese yen, though, much weaker against the dollar, down about 0.3% to 109.42. As far as what the picture looks like in Europe, it is a bit mixed. You did have stocks mostly higher earlier, but now the DAX is a big underperformer in Germany. The Stock 600 right now is essentially flat. I would note, though, that, of course, the UK is back from the holiday, as you are with us today, Francine. And so they're playing a bit of catch up to the gains we saw on the continent yesterday. The FTSE 100 up about 0.6%. In the German bond market, we did see 10-year German bond yields break above 17 basis points yesterday, then gave that back. And once again this morning, we're trading right around negative 20 basis points on the 10-year. While the euro is weaker against the dollar by about 0.5%, there is some massive dollar strength this morning. Euro dollar sitting at 120.01, right there at that 120 level. As far as what the picture looks like here in the U.S., we do look set for a softer open. S&P 500 E-minis down about 8 points. We are seeing yields ticking higher by around 2 basis points on the 10-year to 1.615%. As I said, broadly stronger dollar today. The Bloomberg Dollar Spot Index up about 0.4%. And I just have to note the Bloomberg Commodity Index, Matt, higher for the 11th day in 12, right around the highest since 2018. That commodity rally just keeps rolling on, Matt.
Yeah, we absolutely have to keep focus on that. I know Dan Curtis prepared a special chart for us today just to show how far the commodities rally has run. Even when you put it up against inflation, normally it tracks quite well, but it's really running quite far ahead of inflation at the moment. Let's take a look at what's going on today. It is day 2 of the G7 Foreign and Development Ministers meeting in London. Francine has pointed out we're really focused on trade, and the good news is we're going to get some trade data out. The balanced data comes out at 8:30. Tonight at midnight is the deadline for Israel's Benjamin Netanyahu to form a government, so definitely watch for headlines out of Israel throughout the day. We're also going to get earnings from Pfizer as well as earnings from CVS. So earnings season isn't over yet, but Fran, so far it's pretty amazing. S&P 500 companies that have reported, almost 90% have beat the street's estimates. And typically, you know, they beat 60 to 70%, but 90% is an amazing figure, especially considering analysts have moved their estimates up into the quarter. So they're beating a higher bar.
Yeah, it is pretty amazing. But then you speak to a lot of course, investors, Matt, and they say, look, if you're not beating when, you know, at a time where actually the recovery is kind of roaring, ready to go, and people are getting inoculated because of COVID-19, then it'd be tougher to find another period where actually earnings do so well. Now, onto politics, and foreign ministers from the world's leading economies are meeting in London today for their first face-to-face talks in more than 2 years. It comes amid a range of geopolitical tensions. In a joint news conference ahead of the meeting, the UK Foreign Secretary Dominic Raab and the US Secretary of State Antony Blinken pushed back against what they called Chinese and Russian violations of the global order.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in. I think the challenge for us is to demonstrate in very concrete ways that we can deliver for our citizens.
Meanwhile, relations between the EU and China have soured following the landmark investment deal reached in December. Well, joining us for more is Bloomberg Executive Editor for International Government, Rosalind Matheson. Ros, first of all, it's amazing to see the turnaround and a lot of EU countries following what the Biden administration wants to do with China. And how tricky will it be to talk about Russia?
Well, yes, it comes as we see that hardening of the broader European view on China, despite that investment treaty that was reached in December. And that's because of rising concern over China's actions in terms of its crackdown on Hong Kong and its treatment of the Uyghur population in Xinjiang, in a sense that China hasn't been a particularly good actor during the pandemic. That's even as it negotiated this investment deal, it's still not showing genuine progress in opening its economy. So some collective factors at play. And of course, the concern about China more broadly will feed into the G7 meeting today. And Beijing has in fact accused the UK of trying to turn the G7 into an anti-China bloc. You saw that language from both the UK and the US around what they call agile clusters of like-minded nations, which is code really for China as well as Russia, which will come up as part of these discussions as well. But at the same time, we've heard some concerns from other G7 members, including Japan, who say they're wary about being pulled into an anti-China bloc, and they want the G7 to sort of remain focused on global issues, including the pandemic and climate change.
All right, excellent insight there from Ros Matheson. She is Bloomberg's executive editor for international government. Now, after 27 years of marriage, Bill and Melinda Gates are going their separate ways. That's according to an announcement made on Twitter by the two. The couple jointly controls a fortune of around $146 billion, but made no hint of their financial plans going forward. For more, Bloomberg's Danny Berger joins us. So, Danny, it is one of the world's most influential foundations, the Bill and Melinda Gates Foundation, that the two run jointly. It holds a ton of Microsoft stock, and they're going to continue to run that together, they say. But of course, there's a ton of money outside of the foundation as well, the world's fourth biggest fortune.
Yeah, definitely. Look, they've said very clearly continuity is the message they're pushing across when it comes to their foundation, as you said. But in terms of splitting their fortune, that's a lot more complicated and messy. I mean, not only is it massive, $146 billion, but a lot of it is tied up in more liquid assets. Most of their wealth is in a family office, and it's going to be things like real estate, energy, hospitality. So that's more difficult to disentangle. Now, when it comes to Microsoft stock, Bill Gates personally owns only about 1% of overall shares of Microsoft. As you say, he's been shifting a lot of it into his foundation. So this isn't a scenario where it's going to have that much of an impact on the company and on the company's shares itself. This is a much different divorce than that of 2 years ago between the Bezos family, when it was mostly just a single stock that's where their wealth sat.
Yeah, very fair point. Bloomberg's Danny Berger, thank you so much. Still could be quite the complicated division of wealth there. Now let's take a look at some of the stocks moving in pre-market trading in the U.S. It was the vaccine makers that were really the outsized movers in the Monday session, and they are on the move once again on this Tuesday morning. BioNTech, which is Pfizer's vaccine partner, rallied 10% to a record yesterday and is adding to those gains this morning. Shares up a little more than 2%. CureVac is up by 1.4%. Moderna up by about half 0.5%. The company yesterday committed to supplying 500 million vaccines to COVAX, which of course is helping to distribute those shots in developing countries. We're going to speak with the company's chairman later this hour. The one exception yesterday with the vaccine makers was Novavax. It sank 18%, the most since March 2020, as there's still no update on its vaccine trial results. Those had been expected at some point in April, and of course it is now May the 4th. Though those shares are rebounding just a touch in early hours, higher by about 0.2%, Francine.
Yeah, so much to talk about today. Thank you, Kailey. Now, coming up, we speak with Wei Li, BlackRock Investment Institute Global Chief Investment Strategist. And then, as Kailey was saying a little bit later today, actually in about half an hour from now, global vaccination effort, we speak with Noubar Afeyan, the Moderna co-founder and chairman, about COVAX. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, Kailey was mentioning earlier that we have to keep an eye on the Bloomberg Commodities Index because the outperformance has been pretty spectacular. We've got a chart here that Dan Curtis put together, and I'll tell you for the viewers who are listening on radio, what it shows is that the Bloomberg Commodities Index, which typically tracks U.S. CPI going back to the early 90s, has shot up ahead of CPI. So if you're seeing inflation in terms of the headline number at 2.6%, you're seeing commodities rise almost 6%, and that discrepancy has to be resolved in some way. Let's get to Wei Li. She's Global Chief Investment Strategist at BlackRock Investment Institute. Wei, you do expect inflation, or you see inflation being mispriced by markets right now in the near term and the medium term. What should investors do about that?
Well, right now in the near term, there's a lot of uncertainty because the reopening dynamics, which is very different from a typical recovery, will bring supply demand back online in very unpredictable terms. So I would say that in the near term, yes, we do expect inflation to overshoot Fed's targets, but there's a huge amount of uncertainty in terms of the persistence of that overshoot. In the medium term, however, our conviction is higher for inflation to kind of gradually come through. And here we see inflation in the medium term, 5 to 10 years, being underappreciated by markets because as supply chain moves from being cost efficient to focusing on resilience, that would push up inflation, production cost, and pushing up inflation expectation. And at the same time, thinking about the high debt levels that we have, the cost of kind of rate rising in response to inflation going higher, and what that means for debt servicing is just too high for us to feel quite confident that rates are not going to rise significantly in response to inflation rising fast because of the consideration around kind of debt servicing side of things. So all of that, putting them together, means that we think medium-term inflation is underappreciated.
Wait, how much do you worry about chip shortage? How much do you worry about commodities? Away from the inflation, I know everything's linked, but away from that, is there anything idiosyncratic in the market where that could actually lead to a correction?
Well, the semiconductor shortage is a big focus. You see that coming through during the earnings season, company talking about it as well. But what we are seeing at the same time is that, yes, kind of the drag from semiconductor shortage is there. But at the same time, you're seeing that being offset and more than offset by the very, very powerful restart dynamics. So we may not actually see too much of a dent because of this very powerful restart that is happening right now. And at the same same time, we're starting to see kind of the reaction mechanism kicking in. If you look at kind of South Korea, production coming back up, and also you see Intel talking about greater production, focusing around that as well. So you do see kind of the reaction mechanism in response to the shortage kicking in with a bit of a lag, but that is happening as well. And to your point, Fran, you talked about kind of the commodity prices going higher. That is in response to two forces. Number one is this reopening dynamics in the near term. Number two is this longer term kind of the green transition, what it means for certain metals within the commodity space.
Wait, Matt also had a great, chart looking at some of the earnings, say, it seems like we're priced to perfection right now, so earnings beat expectations by quite a while, but what comes after in the quarters to come?
Yes, earnings, the current season is on track to be perhaps the strongest season on record in terms of beats. It is stronger than Q4, which was already quite strong. But when we look at kind of potentially year-on-year growth, earnings growth numbers of 100%, you have to question this backward kind of looking data, how much meaning you want to assign to that, especially given the strong base effect and the very low starting point that we're comparing this quarter to. So for this earnings season, we're also paying a lot of attention to company guidance and also kind of their rhetoric around margin. That is more forward-looking. We pay attention to that, and that lends itself to more selectivity on the sector front.
Right. It's all about the second derivative, right, Wei, and the rate of change potentially slowing down as we move forward. How do you position for that kind of world?
What we're seeing right now, exactly to your point, yes, second derivative is what markets are focusing on, is that we have entered peak growth acceleration in the US. And with a bit of a lag, maybe 2 months or so, we will enter peak acceleration in Europe. And with a longer lag, we'll see kind of greater acceleration in emerging markets in the rest of the world. So we are seeing this kind of US exceptionalism that started out 2021, broadening out as we go to kind of the second half of the year. And in terms of asset allocation, it would mean that we want to kind of think about within the US equity market, parts of the market that are geared to the international recovery, global recovery story, and more broadly thinking about kind of in the global equity space that would benefit as the baton of growth driver shifts. And specifically in Europe, for example, we have upgraded European equities from underweight to neutral earlier on this year, and now they stand to continue to perform because growth acceleration starts to pick up and vaccine rate starts to improve as well. So really kind of thinking about the growth driver broadening out and what that means for asset allocation.
Wei, thanks so much, Wei Li, their Global Chief Investment Strategist at BlackRock Investment Institute. Now, today, Bloomberg is also hosting its annual Wealth Summit online. Speakers include the chief executives of Rockefeller Capital Management and Betterment. The event starts at 9 a.m. in New York, 2 p.m. in London. We'll have a full lineup, and you can, of course, go on our website and register as well to attend as a participant. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg First Word News. And in India, the Prime Minister Narendra Modi is fighting pressure to lock down the country to control the world's worst coronavirus outbreak. Today, India reported more than 357,000 new infections to cross a 20 million case level. Still, some experts say that a lockdown would be disastrous for the poor. Modi's government has left it up to the states to decide on local lockdowns. In Mexico City, a raised subway track collapsed, plunging train cars with passengers aboard to the ground. Well, at least 20 people were killed and about 70 others were injured. The accident is blamed on a broken beam. The subway line that collapsed opened in 2012. The project suffered from design problems during construction. And Saudi Aramco's profit soared in the first quarter after a recovery in global oil and gas markets. That allowed the world's largest energy firm to keep its quarterly dividend. Almost all of that goes to the Saudi government. The payout is a vital source of cash for the kingdom. And Fidelity has cut its valuation of China's Ant Group in half after the regulatory crackdown. The Boston-based money manager has lowered the implied valuation for Ant to about $144 billion. Now, that compared with the $295 billion valuation in August. The future of Jack Ma's company has been shrouded in uncertainty, and regulators are sorting through details of a fintech industry overhaul. I know we're all looking really at some of these valuations. Over in China, we look at Ant, we look at some of the others as well. Alibaba, I know, has that at the forefront. And then you have this geopolitical concern also with the G7. And it seems that Europe is now going behind the Biden administration. If not a trade war, Matt, certainly being a little bit more combative towards China.
Yeah, well, I mean, if we were in a trade war before, I don't see how we ever got out. In terms of the Ant Group valuation, I think it's pretty stunning. If you think about it, now Ant Group, according to Fidelity, is worth less than Bill and Melinda Gates. And that's before you add the foundation. So on the one hand, this maybe shows the shrinking size of Ant Group. On the other hand, it shows just how large and important the fortune of Bill and Melinda Gates is.
Matt finding a creative way to bring this back to Bill and Melinda Gates. But to your point, Matt, our own analysts here at Bloomberg Intelligence have estimated that in the worst case scenario for Ant, the valuation could actually fall to $29 billion, because if this regulatory clampdown really accelerates, it could mean a serious cut to the company's revenue and profit. So this could get a whole lot worse for Ant before it gets better, Francine.
Yeah, what I find amazing is actually the regulatory crackdown is on concerns we understand from the Chinese government or Chinese authorities, and actually they have a lot of data that they don't share and they're just becoming too big. I wonder whether some of those conversations maybe also need to be happening in the U.S. or elsewhere.
Yeah, they definitely are. And of course, a lot of these tech companies are listed in the U.S. The likes of Tencent, Alibaba, they all have ADRs. And so this does impact the U.S. market as well, Francine.
Now, up next, Grace Peters, JP Morgan Private Bank, EMEA Head of Investment Strategy. We'll ask her about some of the tech companies. We'll ask her about equities in general. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, there's quite a lot going on in the markets, Matt, but it's a little bit bitty. So we're looking at chip shortage, we're looking at commodities. I know we're also trying to figure out what happens to the fortunes of Bill and Melinda Gates.
Yeah, and we're kind of hovering also at these high levels. I noticed earlier that the S&P 500 really hasn't moved much. If you look at weekly change in terms of the price there, it's been up and down. We had volatility and then obviously up since March of last year. But for the past few weeks, it's just been holding steady into earnings season. So we know the market ran up into earnings season. We know companies did quite well. But the question is, where do we go from here?
Yep. Yeah, and then, Kailey, we also had a number, so that's the million-dollar question, the gazillion-dollar question. Then we also had a number of Fed officials kind of weighing in on what type of recovery we'll get in the U.S.
Yeah, Jerome Powell yesterday saying the recovery could be very uneven. But to your point, Matt, it was interesting. I was looking at April, which was a strong month for the S&P 500, up the better part of 6%. 5% of that gain came between April 1st and 15th, and then we only gained 1% in the back half of the month as earnings season rolled out, because we aren't seeing rewards for beats, so it isn't really providing that much of an upside catalyst. Where that leaves us in today's session is softer on both sides of the Atlantic. Actually, the older that the session grows in Europe, the lower it gets. The Stock 600 was in positive territory earlier. Now it is down by the better part of 0.1%. Here in the U.S., we're down about 7 points on S&P E-mini futures. Futures lower across the board, including for the NASDAQ 100. And what's interesting to me today is the FX story. It is a broadly stronger dollar. It probably is more dollar strength than euro weakness playing into euro dollar today. It's sitting right at 120, actually broke below that level earlier for the first time since April 22nd. So definitely interesting dynamics to keep an eye on there. And then, of course, I have to talk about digital currencies as well, not Bitcoin that has my attention this week. Ether, another record high right now, sitting above $3,300. As for some movers in pre-market trading, Matt, would you like to add something here?
Well, no, I was just saying that's one to watch. I mean, I've got my eye on Ether. It's up 1,500% in the last 12 months, and it's taking market share away from Bitcoin. Please continue.
Okay, thank you for that, Matt. Very, very valuable context. I will talk more about Ether and cryptocurrencies, of course, all throughout the week here on Bloomberg Surveillance Early Edition. But as for some stocks moving in pre-market trading, I did want to point out ON Semiconductor Corp. It's interesting. It actually reported earnings yesterday. The outlook beat expectations, and the stock fell on the back of that. But today, investors seem to be changing their minds with the stock up 6% in early hours. CVS Health has not reported yet. That is on deck later this morning, but they could get a boost from the COVID vaccination program, and shares are higher by 2.3% in anticipation of that. Mosaic, the fertilizer maker, though, missed on its earnings report. It's down the better part of 6%. And then Diamondback Energy selling some of its assets in the Bakken shale basin to Oasis, a shale driller, and that stock down 2.5%. Investors don't seem to like that $745 million cash deal, Matt.
All right, Kailey, thanks very much for that. Look at the pre-market movers in the U.S. What I've got is a look at European stocks. You heard Wei Li from BlackRock at the top of the program mention this. Everyone has seen the power of the U.S. economy. Everyone has seen the beats on earnings, and now they're looking for that recovery to move into other regions. Well, if you look at ETFs and inflows, you can see that we had, in terms of the Vanguard FTSE Europe ETF, the biggest inflows since back in November of 2019. So investors are really piling in to European stocks, and you wonder if this rally, or this weight, I should say, will add to a rally in markets that also have kind of calmed down a little bit since earnings season began. We're just about, Fran, halfway through earnings season in Europe, and European companies, only 75 have beaten the street's expectations compared to 90% in the U.S., which either means that analysts are better at forecasting earnings for European companies, or that the performance just hasn't been as mind-blowingly strong as it has in America.
Yeah, and I wonder whether you see value now in Europe or not because of that. So let's get Grace Peters, EMEA Head of Investment Strategy at JP Morgan Private Bank, to weigh in on that. So Grace, I mean, you know, the figures are earnings in Europe, 75% of companies beating estimates. In general, this earnings season has been pretty extraordinary. What does it mean for you know, what you want to buy into now?
Morning. Thank you for having me on the show. No, this has been undoubtedly an exceptional earnings season. And let's not forget the context of this is that consensus forecasts coming into this reporting season have been consistently revised up. So the bar is exceptionally high. So when we talk about that high level of beats in the US and indeed in Europe, both exceptional relative to history, but also that shorter term backdrop as well. But let's not also forget that those beats are not getting rewarded in the same way that they have been in the past. And that, to me, speaks of a degree of investor fatigue. And I think fatigue is the right word, because undoubtedly when we see these beats coming through, our conviction in the upgrade potential for 2021 and the 2022 earnings cycle is only enhanced. We think that consensus expectations for corporate profits are going to rise this year and in the outer year. But fatigue just means that when we're thinking about, you know, the next few weeks and where the market goes over that period, we start to see a wall of worry coming into the market. Worry that earnings aren't following through and you aren't getting those positive share price reactions. Worry that in the US, there's increasing talk of corporate tax increases that could put some downward pressure on those earnings expectations. And of course, whilst we've been in a period of consolidation for US Treasury yields, ultimately we do think that the direction of travel for Treasury yields is going to be higher up towards 2%, if not beyond, by the first quarter of next year. And so as we think over the summer, what could the catalyst be there for? We're looking therefore the talk of Fed ultimately introducing the concept of tapering into its language. So when you put all of that together, we call it the wall of worry. We do fear that equities could see a period of consolidation that extends over the summer months, but we would undoubtedly be buying into any dip if it does arise. And when we think about what to buy, we would advocate for a strong barbell between cyclicality, companies that do well in an improving business cycle and that are highly correlated to those rising bond yields, but also megatrends, area of secular growth in the global economy, like digital transformation and sustainability.
Grace, how will or how would Biden's planned tax changes hinder earnings growth in the U.S.?
Yeah, if you just do a sort of a mathematical calculation based on what's been proposed, you could see up to a $9 per share hit to S&P earnings. That obviously doesn't take into account the offset of greater spending, or indeed the idea that not all of what's been proposed may eventually get through. Our base case is that you will see some of the tax increases ultimately get passed, therefore that you could see about $5 downward pressure to S&P earnings, but that would for the most part be offset by higher spending, infrastructure spending, and therefore the net impact is not going to be too much. There is, of course, a bull case as well, that actually the fiscal multiplier and the impact of that spending means that there's a net upgrade to S&P earnings. And as I mentioned, everything we've learnt through this current reporting season, where we're just over 50% of the way through, indicates to us that the health of the US corporate is extremely good, which in itself puts upward pressure to S&P earnings and indeed to Stock 600 earnings. So we don't think that there is need to be overly pessimistic. Quite the opposite. We expect, towards the end of the year to see consensus upgrades to earnings and therefore price targets. But I think it just speaks to a tussle in the market over the summer as many of these issues get debated and as the forecasts work their way through.
Grace, thank you so much. Grace Peters there, EMEA Head of Investment Strategy at JP Morgan Private Bank. Now, coming up, Moderna's latest pledge for the global vaccination effort. We'll be speaking with Noubar Afeyan, Moderna co-founder and chairman. That's coming up next. We'll talk COVAX. This is Bloomberg.
The experience from countries that have rolled out the vaccines much more successfully than others, namely the UK, US, and Israel, is that it has dramatically reduced the rates of severe infections, hospitalization, and death. And what we're seeing in India is, the health system just simply cannot cope with the numbers. And so we must do everything we can to reduce the number of infections, particularly severe infections, which, many of these vaccines have shown to be highly successful at.
Well, that was a World Health Organization Science Council member speaking to Bloomberg. Now, as the crisis worsens in India, pressure is growing on the global vaccination effort. Moderna has agreed to provide as many as 500 million doses of its COVID-19 shots to the Global Access Program, known as COVAX, but only a small fraction of the shipments are due to arrive this year. Well, joining us now is Noubar Afeyan. He's co-founder and chairman at Moderna. Thank you so much, Noubar Afeyan, for joining us today. First of all, congratulations on this tremendous effort. A lot of people, though, especially when you look at the pictures coming from India, say, could this not be done sooner? A lot of the shipments are into 2022. Can we get it done quicker?
Well, first of all, thanks for having me. We have been working for several months to establish this agreement and also to obtain WHO emergency use license, which we did last Friday. And the discussions have led to the announcement of 34 million doses being available later this year. It's really a question of our supply obligations throughout the world and our production capacity. And we're ramping up our production capacity as quickly as we can. We're producing roughly 1 billion doses this year at a maximum. But next year, we also announced we'll be increasing to 3 billion. So we are working as a manufacturer absolutely as rapidly as we can, as are others. Look, the reality is that there's a number of countries that have also sourced the vaccine, and we hope, together with our supply, some of the countries as well will consider what their needs are so that we can get
Noubar,
as many doses to the rest of the world as we can.
what can you tell us about pricing?
We have used a tiered pricing system with this being at the absolute lowest price. It's been negotiated. There's a transparent way in which we've gone about it with the various entities, countries that we deal with, as well as COVAX. And so we haven't said much more than that, only to say that we certainly take into account the purpose of the COVAX facility, particularly as it gets to lowest income countries, the 92 Gavi countries. We're very, very pleased to be able to tap into that and bring our technology, our capability to bear.
How worried are you about new variants circulating that have not been identified because a lot of countries have not been vaccinated yet?
We are worried about that as we were about the virus last year, in the sense that there's an element of the unknown. Now we know a lot more about the parent strain that we were going after. As you know, we have begun human trials very rapidly on a variant vaccine against the South African strain, as well as a booster for the original vaccine, and in fact also a combination. And uniquely, Moderna has shown data in animal models, and we hope soon to have human data showing efficacy for the variants. But then, as you say, variants are beginning to spring up with yet different properties, and we're going to have to stay vigilant, potentially developing yet more boosters. And we hope to keep this at a minimal challenge in terms of how many different approaches we need to have. But at the end of the day, the virus is doing its own thing, and we need to be able to stay ahead of it.
Will you be able to maintain production goals for next year? Are we still going to see, 3 billion shots produced by Moderna next year?
Yes, we increased our forecast because of significant investment that we're making as we speak ahead of that to 3 billion doses. I'll also say that we're actively testing doses that are lower than the original vaccine that we went as fast as we could last year to produce. So to the extent that we can get the vaccine, which today is at 100 micrograms, to show effectiveness at even 50, of course, that will instantaneously double our output of doses as well. So we're doing everything we can, recognizing the need far, far outstrips what we had anticipated, especially given the alternative vaccines that are also coming out and concerns people have with variants. So yes, we are committed certainly to do everything we can, investment being a big part of that, expertise being brought to bear, and we hope that we'll meet our goals as we are doing this year.
Noubar, on the point of variants, and going back to what you said earlier about potential booster shots, trials you have to have the vaccine address different variants, does that mean that the shots you're rolling out to COVAX in 2022 are going to look different than the shots that are currently going into the arms of people today?
We will work with our COVAX partners to ensure that we have the most effective vaccines for the conditions that we need to go after. So that is indeed an issue that's going to require some level of forecasting depending on where we are. But what the overall structure certainly has a supply number in mind. Exactly what that consists of, whether it's primary a vaccination or it's a boost, as well as whether it relates to variants, that has to be worked out, by the way, with COVAX as with everywhere else.
How far out does your production planning go, Noubar? Do you have plans going out for investment in production in 23, in 24, in 25?
Certainly, we're looking into 23 as we speak. We have said publicly that based on the best available information and our own work, we believe that this virus may well end up taking on an endemic character in the sense that there may be enough variants that we start seeing some form of it in various kind of seasonal fluctuations. So, it's not a sure thing, but it may well settle into a behavior that's similar to seasonal flu. We don't know that for sure yet, but we need to be prepared. One thing we've learned from this pandemic is that we can't hope for best case situation, prepare the least for that case, and then find out that it's not that. And so we need to do the opposite. So I think, yes, we are looking at 2023, but indeed, if we can get up to 3 billion doses, and if we can get even lower amounts per dose to show the same effectiveness, that will start putting a pretty significant dent on the global demand alongside our colleagues in the industry who are also using the mRNA technology to increase supply yet more.
With hindsight, Noubar, what should we have done differently with COVAX?
Well, look, COVAX has been stood up under an emergency situation and has faced a very challenging situation because on the one hand, they needed to secure support from countries and other institutions, even while trying to cut deals with vaccine manufacturers, which, you know, a mere 3-6 months ago, the picture looked different as to which vaccines to source. So they did, I'm sure, the best that they could. And what they're finding is that the situation is shifting. And we're just pleased, although it's been many, many months in the making, that we're able to reach this milestone. And I look, being in the trenches in some level, Moderna as a company for so many months and watching our colleagues in OWS in the US, the NIH and others as well in the trenches, I have sympathy for others in the trenches that are likewise trying to figure out what's the best that can be done. So I just want to encourage them to keep going.
When do you think the world, and I know this is a big question, will actually reach herd immunity? And do we need to vaccinate children to reach that point?
Again, there's a bit of speculation involved in that, but I would say given the seriousness of the disease, vaccinating children seems like the better approach than not, because one of the things that nobody is factoring in is what the downstream health consequences of this disease are post-infection. The notion that children don't get a hard version of this is one thing. The notion that that won't have later stage effects, I think, is just an unknown. So herd immunity is something that I think will only be judged in hindsight. When we see the burden alleviate, then we're going to say, oh, in hindsight, we reached herd immunity. People are talking about it as though it's a knowable thing. I don't believe it is. I certainly think we should get as many people vaccinated as quickly as we can. And of course, throughout the world, because otherwise we're just not going to be able to contain the virus as we're seeing today in India and elsewhere.
Noubar, thank you so much. Noubar Afeyan, their co-founder and chairman at Moderna, talking about COVAX. Now, coming up in the next hour, Dr. Amish Adalja. He's Johns Hopkins Center for Health Security Senior Scholar. That's at 6:30 a.m. in New York, 11:30 a.m. in London. And this is Bloomberg.
There's nothing new in crypto, so volatilities are everywhere. And actually, Bitcoin, Bitcoin is probably less volatile than similar-sized assets like Apple stock or even Tesla stock.
Well, that was the chief executive of Binance talking crypto yesterday on Early Edition. It was a great interview. Thanks to Matt and Kailey. Now, what else are we watching? A lot going on, Matt.
Yeah, I'm watching Ether. I mean, Kailey highlighted earlier the rise that we've seen. 1,500% in the last 12 months. It's up to, today I think it hit 34.55. And a lot of investors are looking at Ether at this level and saying, it seems expensive. On the other hand, we thought Bitcoin was expensive at 34.55. And that FOMO that's hit them in the Bitcoin run, I think, is pushing them into Ether. We can see the Ether Bitcoin ratio climbing to its highest level in almost 3 years. I will tell our listeners on London DAB Digital Radio, first of all, I applaud you for listening to Bloomberg on radio. And the only thing you're missing out on is this chart. It's 88.19 in the terminal, and it just shows the resurgence of Ether against Bitcoin.
Still has a long way to go to catch up entirely to Bitcoin, though, Matt. Bitcoin's value over $1 trillion. I am watching trade balance data here in the U.S. at 8:30 a.m. Eastern time. We could be set for yet another record deficit. Economists estimating a deficit of $74.3 billion. Francine.
Yeah, I'm looking at the G7 in London, and I'm also looking at how Europe deals with China. Now, plenty more coming up. We speak with Ian Shepherdson on Bloomberg Surveillance. This is Bloomberg.